Now we'll try to understand the third forward commitment, or the third type of forward commitment, which is a swap. Now let's say you are an entity, you have taken a loan for 2 years, that is 2 years is the maturity period of the loan, and the payments are quarterly. So you have taken the loan at t is equal to 0, and there are quarterly payments, right? T is equal to 1, 2, 3, 4. This is the end of the first year. Then there is 5, 6, 7, 8. And there is end of the second year. Your loan completes at the end of the second year. That is when t is equal to 8. Right? Now you have taken loan here. T is equal to 0. Now this loan has a special characteristic. This loan is a floating rate loan. So if interest rates rise, your cost rises. If interest rates fall, your cost falls. Now you feel that in the coming 2 years, the economy, because it is facing very high inflation, the central bank might increase the rates. So which means your cost is, according to your speculation, your perception, it may rise. So you do not want to keep the risk of rising interest rates on your account. You want to pass it on. Now how do you pass it on? You can pass it on by exchanging the floating rates or the floating rate payments for fixed rate payments through a swap. Now how do you do that? Let's take an example. So let's say you have this loan, floating rate loan. Let's call it FL, and you have the payments. And you have, because it's a floating rate loan, you have variable payments. Let's say they are given by S1, S2, S3, S4, S5, S6, S7 and S8. These are your variable payments or floating payments. That is, they depend on the rise and fall of interest rates. Now, as we said, that you think that the interest rates are going to rise. This means that your payments you think are going to go up. So you do not want to keep that risk on your account. Now what you do is, you go to a swap dealer. You go to a swap dealer and you tell the swap dealer that you want to get into a swap which takes from you fixed payments and in return gives you back the floating payments. So you say, I will give you the fixed payments, something called FX, let's say. I'll give you this fixed rate FX, and in return you will give me the variable payments. Let's denote it by SI. It can be S1, S2, S3, S4, whatever. Now what happens is, your payment has become fixed and in return you are getting the variable payments. So in each of these terms you are paying the swap dealer FX, and in return the swap dealer is paying you S1, S2, S3, S4, S5, like this. These payments are being paid by the swap dealer. Now what is the net value of this swap, friends? So the net value of this swap, let's say at maturity, given by capital T, here capital T is equal to 8, right? So here the value is sum of the variable payments minus sum of the fixed payments. This is the value to the person who has taken the loan, that is you, the person who has taken the loan. And the value to the dealer is exactly the reverse of it. Minus VT is equal to sum of FX minus sum of the variable payments. This is the value to the swap dealer. So the swap dealer, what the entity does is, it fixes the FX, that is the fixed payment, based on its own perception of what is going to be the future interest rates. Whether it has a perception that it is going to rise or it is going to fall, it is going to give you a fixed rate which it feels is going to end up making the dealer have some net margin. That is the goal of the swap dealer. Now, if the speculation of the swap dealer for these interest rates for the next 8 periods or 8 quarters does not match with the actual numbers, then there are chances that the swap dealer will be in loss. And if it matches with the swap dealer speculations, then the fixed rate will be most of the times it will be such that the swap dealer will be in profit. So if the swap dealer is in profit, that means the person who has entered the swap, that is you, will be in loss. And if the swap dealer is in loss, then you will be in profit. So that's how it happens. Let's say a company named XYZ Inc. has entered into a floating rate loan. Now, the feature of this floating rate loan is, naturally, if the interest rates rise, the costs will rise, and if the interest rates fall, the cost will go down. Now let's say the loan has quarterly payments and its maturity is in 2 years. So there are 8 payments till maturity. So the loan has been taken, let's say, at t is equal to 0, and the payments are at t is equal to 1, 2, 3, 4, 5, 6, 7 and 8. So at t is equal to 8, the loan matures. That is, all the payments are paid. T is equal to 4 is the end of year 1 and t is equal to 8 is the end of year 2, which is the maturity period of the loan. Now, because these are variable payments, this floating rate loan has variable payments. Let's say these payments are given by S1, S2, S3, S4 till S8. Now, XYZ Inc. has an opinion about the future interest rates. It thinks that the interest rates are going to rise. Because the economy is under inflation, XYZ Inc. is of the opinion that the interest rates are going to rise, which means its costs have the risk of going up. Now, it does not want to keep this risk with its own account. It wants to mitigate this risk. Now, how can it do it? What the entity can do is XYZ can go to a swap dealer. It can go to a swap dealer and get into a swap which pays the entity the floating rates in exchange for a fixed amount on a quarterly basis. So now what happens is this S1, S2, S3, these payments are being paid by the swap dealer in exchange of a fixed amount being paid by the XYZ entity to the swap dealer. So now the XYZ entity has payments obligation of FX every quarter. This is a fixed amount, let's say. So every quarter, this amount XYZ is paying. And it is paying to whom? It is paying to the swap dealer. And in exchange, these floating rates, S1 till S8, they are being paid by the swap dealer to XYZ. So these variable payments are being paid by the swap dealer to XYZ. Okay. So this is a fine setting. So friends, at maturity, what is the value of this swap? So at maturity, the value of the swap to XYZ is equal to sum of the payments it is receiving, that is sum of all the variable payments, minus sum of the payments it is paying, sum of all the FXs, right? And the contrary goes for the swap dealer. So value to the swap dealer is equal to sum of the payments it is receiving, that is FX, sum of all the FX, minus sum of the payments it is paying, to sum of the all variable payments. So this is the value at maturity of this swap. How the cash flow looks like? Basically what is happening is there are 3 entities. So there is the lender, lender to XYZ, there is XYZ, and there is the swap dealer. Let's call it SD. Now, XYZ is paying FX at each period to the swap dealer. The swap dealer is paying the variable payment, SI. This variable payment, XYZ, is paying back to the lender. So the lender gets what it wants, XYZ gets what it wants, and the swap dealer also gets what it wants. Swap dealer generally fixes a rate of FX in this kind of a swap based on its own assessment of the markets, the interest rates, etc., etc. It has its own expertise to fix the rates. Now, if its speculation is wrong, then it can be in the losing side, and if its speculation is right, then it will get a net margin after the swap deal is completed. So that's how a swap works. Now, what are the features of a swap? It is an OTC contract. So in that sense, it is more like a forward contract rather than a futures contract. So obviously, if it's an OTC contract, it will have more flexibility. It will have more privacy, and it will have counterparty risk. This will be there. Additional features of swap, it has, rather than having a single payment, it has a series of payments. Now, what can the payments be? It can be fixed for a floating rate or another fixed rate. It can be variable series of payments based on one underlying against a variable series of payments against another underlying, or a fixed series of payments against another underlying. So this is how it works. A variable series against one underlying against a variable or a fixed series against another underlying. Now we are in a position where we are able to define the swaps. Let's try to define it. So, a swap is an over-the-counter derivative contract which binds the buyer and the seller of the contract to exchange a series of payments between them, where one end is variable following an underlying asset or rate, and the other end, that is other end of the payment, is either variable or fixed following another different underlying asset or rate. I'll repeat once again. A swap is an over-the-counter derivative contract which binds the buyer and the seller of the contract to exchange a series of payments between themselves, where one end of the payments is variable following one underlying asset or rate, and the other end is either variable or fixed following another different underlying asset or rate. Now, pertaining to swaps, let us understand who is a buyer and a seller. In our example, friends, the swap dealer is the seller and XYZ is the buyer. The buyer, as we said before, the buyer is the long person or the long entity, and the seller is the short entity. How do you confirm it? Let's say if interest rates fall, who benefits, friends? The one who is paying the variable payments in this swap. Who is paying the variable payments? The swap dealer is paying the variable payments. So, the swap dealer has a short view of the interest rates. On the other hand, if interest rate rise, who benefits, friends? Obviously, it is the XYZ entity, because now the increased payments are being borne by the swap dealer and XYZ only pays the fixed amount. So, XYZ is actually long entity. It is having a view that interest rates will rise and accordingly it is in the bet. Swap dealer is of the opposite view and accordingly it is in the bet. Now, we will come to a few other concepts. First, let us talk about the concept of netting. What does netting means, friends? Let's say in our given swap, we had periodic payments which were equal to the difference of the variable payment and the fixed payment, right? Now in case of a swap, the rule is the differential payment has to be made by whoever has the higher payment due. So for example, if in any period, let's say I, t is equal to I, if the variable payment is greater than the fixed payment, then the swap dealer has to pay, right? And in some other case, if the fixed payment happens to be higher than the variable payment for that period, then the company has to pay, XYZ has to pay, right? So at each period, only one of the parties has to pay, and the amount is equal to the differential of the two amounts, whichever is higher. So at each point, the person who owes the higher amount can default. You're understanding? So at each period, the person who owes the higher payment amount has the chance to default. The lower payment amount entity does not have any chance to default, because the rule is only the differential payment has to be paid. This phenomenon of only paying the differential amount is what we call netting. Then there is another concept called notional principal. Now in our example, neither the company XYZ nor the swap dealer exchange any principal amount between them, but a principal amount was taken into consideration to calculate the fixed or the variable payments. Hence we say that there is a notional principal based on which a swap agreement happens. It is not exchanged between the parties, but it is taken into consideration while considering the variable or the fixed payments. So this is what notional principal is. Now friends, we'll move to the next category of derivatives, which is contingent claims. And the primary kind of contingent claim is an option. We will try to understand what is an option next.